All right, yield nerds, episode 160. This feels like the spring sales event, except for the financial markets. I saw what is happening and I started trying to figure out, hey, maybe I should jump into all kinds of stock buys. And I did my research. I want to share my research with you. I learned a lot and I hope to learn from you too. Speaking of which, there are 462 of you who are following this. Thank you so much. I'm honored. And there are three playlists. I encourage you to use them. The roadmap is what organizes this show in time order. And most importantly, I am sharing my education. It may be wrong, so please make sure you check it and you do your own homework. Well, four parts in today's agenda as I fish for dollars in front of the New York Stock Exchange, and it seems to be flooding. That doesn't look good. So we'll take a quick market temperature of how the market is doing, and I'll share my portfolio strategy again, and we'll play Yield Superbowl because I think there is another surprise here. The Yield Superbowl doesn't disappoint these days. And then, based on all of that, I will share my investment thesis and my holdings. Well, my entire portfolio continues to not blink. I'm on the positive territory for returns this year. NASDAQ is negative 14. Ouch. Well, and there is a reason for that. Even as I say that, my equity portfolio, which is very heavy on the Russell, is taking a beating. My equity portfolio is down about half as much as NASDAQ. But the reason my entire portfolio barely notices is because only 1% of my allocation is to equities. And I'm picky and choosy about what I buy, how long I hold, and I'm just not ready to jump into the stock market barring certain events. And I'll tell you what they are soon. Yield Superbowl. If you're new to Yield Superbowl, I encourage you to look at some of the past episodes and understand how it is the pre-tax, yield. And so I adjust the things such as treasuries by adding state tax. I also use effective tax and not marginal tax when looking at tax advantaged, allegedly tax advantaged municipal bonds. So if that concept is new to you, I encourage you to please go back and refresh your memory. And before I jump any further, I want to make sure you know that I am not a wealth management advisor. This is not investment advice or tax advice, and I don't do product politics or sell snake oil. Well, why do I call this the spring sales event? And I'm sorry for being facetious. There is a lot going on. We got tariffs, we got counter tariffs. There may be some new conflicts. The US is rearranging its attack force in the Middle East. And the full employment of unemployment numbers is not even out. The yield curve is doing things that I've never seen it do. And, we may have some new entrants into the market the way it is going. We may have Russia entering the free markets. Who knows? So, what all of that means to me is there is a lot of uncertainty still. There isn't good levels of clarity. And the yield curve, you may remember, and I showed this to you a week ago, looks like a yield cup. And what a difference a week makes. Believe it or not, here is the new yield curve. It is a steeper cup. It still is a cup, but unilaterally rates have fallen. Now, why would yield fall? It means a lot of money has gone into treasuries and bonds, and because new money is coming in, it is driving the price higher. When the price is higher and you get the same coupon, yield goes down. So if you are sitting on treasuries, all of your holdings went up in value. And the reason it went up in value is people were willing to pay more to get the same yield. That is what is happening. As the stock market is burning, people are running into the fixed income market. Welcome, people. I've been waiting for you. And still, the shape of the yield curve is very unique, and we need to be very careful about what to do. At least I'm going to be thinking hard about it. So I started thinking about scenarios. What are some of the scenarios that could happen? And the first one is the front end of the curve could completely collapse. Now, why would that happen? This would happen if Chairman Powell says, you know what, I'm just going to drop rates to stimulate the economy. Well, it does a couple of things in addition to stimulating the economy. It decreases the debt level. And so Chairman Powell could do that. And, when COVID started, we dropped the rates by 2%. And all that this contemplates is dropping rates by 1/8%, which, is very conceivable. a 50 point and a 25 point, drop in yields, and the curve will look like that. Could it happen? Sure. The pro of that is it will send a signal that the government will do everything it can, the Fed will do everything it can to support the business. And if the Fed were to do that, however, it also signals that we got some serious problems in the economy. And whether you believe it or not is entirely your story, and you keep your story. But what it means to me is if the front end of the yield curve collapses, I will be buying stock because I will take that as a signal that it is the bottom of the stock market and the Fed is rushing in to rescue it in rapid order. So that is one path. Well, the second path, this is the good, bad, and the ugly, and there is really no good. So it's the bad and the ugly. The second path is bear steepening. So the tail end goes higher. What would make the tail end go higher? In this scenario, fear of excess debt is driving up the yield. And what does driving up yield mean? Nobody wants to own long-term bonds. And if you don't want to own the 10-year, then the Fed has to pay a higher coupon in the long end. Their auctions aren't going at a lower price. And please remember that what has been happening is the opposite. People are rushing to buy long-term bonds, but this could change. If there is doubt about whether the debt would get paid or not, people would run away from the 10-year and they would dump it and the price would go down, which means the yield goes up. In that scenario, I suppose those of us who still believe in the 10-year will jump to the 10-year and buy it at very nice high rates. However, the dollar's reputation will get damaged. So this is the bear steepening scenario. And then there is a third, more boring and yet more scary, somehow more boring and scary scenario, and that is that things stay the same. What do I mean by that? We still have high rates in the short term, and we have inflation, and we have unemployment. And that is a terrible reality, which I hope we don't get to. Now, Chairman Powell will, within reason, rightfully say, hey, you know what, we're controlling inflation. We cannot drop rates. The reason we cannot drop rates is inflation is still increasing. And if inflation is not down to 2% and we drop rates, inflation will creep up again. I cannot do that. So Chairman Powell may say we're going to keep front end of the rates high. If that happens, then inflation may be controlled. However, it will harm the GDP because all of these unemployed people who are looking for loans, who are trying to start businesses, they may not be able to afford these high rates of borrowing. And so the economy will start grinding to a halt. This is a scary one. The bear steepening has its own kind of fear. The front end dropping signals a recession, and stagflation is the third one. So I started sitting back saying, so where are we going to go? And so I started digging into stagflation. Stagflation means higher unemployment, lower GDP, and higher inflation. Is that what is really happening? Let me check. Here are new factory orders, and all of the references for these are posted in the video, so please feel free to look at the description. So this is the Institute of Supply Management, which shows that factory orders have dropped precipitously. What that means is GDP or production is decreasing. The employment index is dropping, which means unemployment is increasing. Prices paid is increasing, which means inflation is increasing. Are you hearing what I am reading? Higher inflation, higher unemployment, lower GDP. That is the textbook definition of stagflation. It's not enough if it happens in a month here and a month there. It needs to happen on a longer basis. But we are staring down the barrel of stagflation. So I said, okay, let me check a couple of additional sources. And this is the Fed data. The real GDP. Now, what's real GDP? Real GDP means you take out the effects of inflation. So you can say an economy grew at 3%, but if inflation is 2%, the economy really only grew at 1%. That's real GDP. If you look at real GDP, it is also coming to a crunching halt while unemployment is going up. Then you look at these two and go, okay, well, GDP is decreasing, unemployment is increasing. I just hope inflation is under control. Oops, PCE inflation is actually increasing. So here is what this means, as raw as the data is saying. it is highly likely that we are headed into stagflation unless the economy crashes suddenly and Chairman Powell decreases rates, or we have an even worse scare with the debt ceiling and bear steepening happens. So my instinct is Chairman Powell doesn't call me to tell me what he's going to do, and I certainly don't know what's going to happen to the debt ceiling. The easiest thing I do when I need to freeze is keep short term. So I'm going to keep the vast majority of my allocation short term. I am buying some agency bonds. If you want to know why, I explained that in my previous episode. But in the agency bonds, I'm going to between the 1 and the 3 year area and picking up agency bonds at much higher yields than treasuries. But my real goal is that if indeed there is bear steepening, I want to pick up the 10-year, but ideally at 5%. So I'm just going to keep my powder handy, realize 80 plus 20 is 100. So everything I'm doing is on this side of the curve, but I will go to the other side of the curve up to 20% of my portfolio when the 10-year increases. So what are my holdings? Pretty much focusing on fixed income because that's 90%, 99% of my holdings. 78% of my holdings are in treasuries, 11% in agency bonds, and I have increased that allocation, and 9% in investment grade corporate bonds. These are the Mercs, the BNSFs. I've reviewed these before. They pay 5.4% yield to maturity for 30 years. And I'm just sitting on it, waiting for the market to catch up. And as far as my duration goes, my short-term duration is all treasury, medium is all agency, long is all corporate. Other than that, I did want to come back and answer a question that one of our colleagues asked. They said, hey, what do you think about the tanker market or gasoline and fuel? And there is a wonderful, wonderful organization called the Poten and Partners, and they have a weekly subscription. I read it because I'm very interested in this stuff. Feel free to subscribe to it. Once a week, they'll tell you where the tanker market is going. And their most recent topic I thought was very interesting. It said, hey, the OPEC is bringing a surprise. And they show how the Saudis have kind of sort of maintained their production. However, it's really these other people, the non-Saudi OPECs, the Kuwait, Russia, Kazakhstan, those barrels have gone off. And of particular importance, I would say, is that the UAE's production is starting to pick up. And when UAE goes around the OPEC bloc and tries to pump more oil, the Saudis said, you know what? We're going to pump more oil as well. And that's a surprise because you would think they want to make a higher price for a given barrel. But the Saudis and the OPEC in general said, we're going to make more oil. You can see the average height of the total OPEC output has kind of dropped after COVID and never really picked up. They have indicated they're going to go back up by 2 billion barrels a day. It's kind of insane. And so if that production picks up, it has to go somewhere. And from Saudis, from the Middle East, if it goes to India, if it goes to Africa, if it goes to any of these places, the question is, what kind of a tanker is it going to go on? And this tells you that the VLCC, meaning things going all the way from the United States to far, far away, those go in really large vehicles. The Suezmax and the Aframax are the smaller tankers. And what this is showing is the real place where the volume dropped was the VLCC. However, when the Middle East starts pumping more, when the OPEC nations start pumping more, according to Poten tankers, they believe it is the Suez and Aframax which will see the increased volume, not the VLCC. Then you have to say who owns most of the Suezmax and Aframax tankers that we can invest in. There are many owners, Greek owners, Chinese owners, and so on. But who owns in the US investable stock? And surprise, surprise, TK Tankers is positioned beautifully to win. If you go to TK Tankers and on their fleet page, you will see they own several Aframaxes, several Suezmaxes. And so when it comes, and it may take another month, but when it comes, TK Tankers will once again be looking at a nice positive return. Right now, they've taken it on the chin. The last year, they've fallen by almost 50%, even though for the last 5 years, they're up by almost 100%. But I would anticipate, based on reading Poten Tankers, in a couple of weeks, when that oil needs to go somewhere, we're going to be chartering TK Tankers and going out to the sea. Well, thank you for listening to Yield Nerd. Even a broken clock is right twice a day, so please remember to do your own research. Have a good day.